Welcome, everyone. Great to see you, as I always like to start off this with. And I know, of course, we cannot see you, but I'm glad to welcome Gary Zimmerman of MaxMyInterest to have a great conversation today about cash. And before you click pause or you turn off, I want to make sure that you know that this conversation is for you if you are just starting off in your career or long retired in your life. This is an important asset class. You heard me talk with Horizon Investments this summer, with Beacon Capital Management this summer. You've heard me talk with Morningstar, all about stocks and bonds. But this other asset class is very important. And if you haven't had that conversation with me in the past, this is a great opportunity to take just about 20 minutes, hear from someone who is working in cash. I think you'll find the starting of the business an interesting story. So let me introduce Gary. He is the former managing director at Citigroup as the global head of strategic solutions to sovereign wealth funds with over $5 trillion in them. He graduated magna cum laude from Harvard and is also a graduate of the Wharton Business School at University of Penn. Gary, welcome. So glad to have you join us. Really appreciate your time. I guess you just kind of caught the bug to start a business. Working with $5 trillion sovereign wealth funds just wasn't much fun. So you decided, hey, I'm going to start a business.
Well, Lou, thank you for having me on your show. And it's a pleasure to be here. The Max business is really accidental. I spent the first 15 years of my career as an investment banker, and I was advising corporations and financial sponsors and sovereign wealth funds on M&A and direct investments. And that was a lot of fun, actually. I really enjoyed that job and got to meet a lot of interesting people and spent a lot of time traveling around the world. But what happened is that I ended up taking an expat assignment in Japan. And it happened to coincide with the financial crisis. So probably a month or so after I landed in Tokyo, all of a sudden the financial crisis took hold, and it was a pretty tumultuous 3 years in the market. And one of the consequences of the financial crisis is that the very bank where I was working had a near-death experience. I watched its stock price go from $55 a share to 97 cents a share. And that was pretty educational. I think, so much of understanding markets and understanding financial planning is really having the experience of having lived through multiple market cycles, because you get to understand the human emotions that impact investing. And I think actually one of the great values of a financial advisor is helping you manage through those emotions. So anyway, here I was stationed as an expat in Tokyo. The bank where I was working was on the precipice, and I was a little concerned about all of my cash, and because it was above the FDIC limit at that bank. And I said, well, gee, if this bank were to fail, every dollar above the FDIC limit would leave me as an unsecured creditor. And that's kind of a scary thing, because when you think about it, the reason you hold cash is for safety and liquidity. And here I was potentially at risk of losing a lot of cash. And so the bank pitched me on one of these brokered deposit solutions. Often they're called cash sweep solutions. And basically the way that they work is the bank takes your money, they resell it to a third party. That third party puts it into omnibus accounts. This is all really complicated. And
so I boil it down for us, Gary. That's fine.
Yeah. Well, I was like, well, gee, this is really complicated. Why do I want to give my cash to a third party who's going to resell it to someone else who's going to give it to some other bank? So I don't even know which banks they are. And what if I need my money? How can I get it? Because I can't just call up the bank directly and get my money anymore. And so even to this day, there are a lot of people running around pitching these, brokerage accounts that hold cash that are custodial sweep solutions. And, often I've found that the best solution is the simplest solution. And when it relates to cash, which is the simplest asset class, you really want to make sure your money is safe and liquid. And so I read the fine print on this product and I said, no, thank you, not for my own money. I sort of said, well, what's the right solution? And the simplest thing I could think of was just to open more bank accounts directly in my own name. And that way I would know exactly where my money was. I knew that it was within the FDIC limits. And if I needed access to it, I could call any of the banks and wire funds out same day. And so that's what I did. I just opened up a series of bank accounts. And then what I found over time is that managing all those accounts was actually a decent amount of work, because not only did I have to make sure that even with accrued interest, the funds stayed below the FDIC limit, but I noticed that those banks were changing their rates all the time. And, when I opened the accounts, Bank A had the highest rate and now Bank B has the highest rate. And I thought, well, gee, like these FDIC insured savings accounts are effectively a commodity, right? They're all backed by the full faith and credit of the US government as long as you stay within the FDIC limit. So I started moving money from bank to bank to effectively, chase the highest yield, make sure I was always earning the highest amount. And
protect
I did
your
this
money as well.
Yeah. And so the number one goal was keep it safe, right? Keep it liquid. And then once I'd satisfied those two basic human needs, then it was, okay, well, I should make sure I'm earning as much as possible on it. And this went on for 3.5 years. Every month, log in, check the balances, move funds around. And I finally got tired of doing it, Lou, and I was about to stop. And I looked back and I realized I'd picked up $40,000 of incremental risk-free return. And I thought, gee, this is really interesting, because at that point in my life, $40,000 wouldn't change my life. But in finance, you're taught to look out for arbitrage opportunities. That is, opportunities where there's incremental return without an incremental risk. And what was so fascinating to me about the banking market is there are about 4,500 banks in the United States right now. And every one of them offers a different interest rate on exactly the same product, which is an FDIC insured savings account. And I thought, well, gee, this is really interesting. Here's this multi-trillion-dollar market, and it's inefficient. And it's inefficient because people either don't know they could be doing better, or they don't care, or they don't have time. And so I thought, well, what if we could create software that would make it really easy for people to make sure that they were always getting the best deal? And the more time I spent thinking about this, the harder it was to think about anything else. And so I left my day job, and we started the business and have been running ever since. And it's been about 10 years.
All right. Well done. You give me the opportunity. Necessity is the mother of all invention, correct? So there you were, looking for a solution and decided to take matters in your own hand and create it. So well done on your part. So recently I read an article in Financial Planning magazine, which prompted reaching out to you and having this conversation, which I was so glad to get a response that you would share it with us. You said it would be wise to talk with clients about cash. So for everyone watching, I am doing as Gary said and being wise right now on your behalf, and we want to have a good conversation about it. Let's get to two abbreviations: SIPC, so Securities Insurance Protection Corporation, versus FDIC, which is the more recognized name, we'll say. Would you please just give us a few moments on what is the difference between SIPC versus FDIC for clients?
Sure. So the Federal Deposit Insurance Corporation was started in 1933 under President Roosevelt, FDR, following the Great Depression. And the idea was that he wanted people to feel confident keeping their savings in banks. And the way to do that is to equalize the risk. So pre-FDIC, as a depositor, you really had to assess each bank and understand their loan portfolio and their liquidity metrics and understand whether they were a safe place to keep your cash. The problem is that 99.99% of Americans are not qualified to do that, nor should they have to be. And so the idea behind the FDIC was that the federal government would create an insurance fund, which in turn is backstopped by the full faith and credit of the US government, that would basically said, if a bank were to fail, the government will step in and make you whole for your deposits. And that was wonderful, because now you didn't have to worry about which bank you chose, and you didn't have to worry about which loans the bank was making, because you knew that the federal government was there to backstop it. Now, there is one caveat, which is it's only insured up to a certain limit. And the FDIC insurance limit today is pretty high. It's $250,000. And it's $250,000 per depositor, per account type, per bank charter. Now, that sounds really confusing. And it is a little bit confusing because account type doesn't mean checking versus savings. Account type means title. So an individual account is different from a jointly titled account. So for instance, if you have a spouse or a partner and you go to the bank, I can open up an account and have $250,000 insured. My wife can open up an account and she can have $250,000 insured. Those are both individually titled accounts. And then we can go to the bank and open up a joint bank account, which is a different account type. And we each get another $250,000 of insurance that way. So you can get a fair bit of insurance coverage through a single bank. But oftentimes people want to diversify a little bit and spread out their cash. And part of that is for safety, but part of it is for liquidity as well, which is if your bank were to fail and your funds are FDIC insured, you will get them back. But you may not get them back today. And often there's a resolution process that occurs, and either the FDIC takes over the bank and merges it into another bank, and now that other bank will take over your deposits, or sometimes they have to sell off the assets. And typically you will have liquidity the next business day, but it could be a week and it could be longer. It really depends on how that process goes. So a lot of what we advise people is the same thing that a board of directors would advise their company, which is in life, avoid single points of failure, right? If you're an auto manufacturer and you make cars and you have a big assembly line, you wouldn't want to be beholden to a single supplier of auto glass, because if there's a fire at that factory, now your whole production stops.
That's right.
And the same is true with your personal finances, right? You might benefit from having an account at more than one bank, because if anything were to happen to one of your banks, it's nice to know that, well, I can always go to this other bank and get money same day. So liquidity is a really important part of cash. So that's what the FDIC is. It's there to provide government protection so that you can feel safe and confident keeping your funds in any bank that is FDIC insured, as long as you keep your money below the limits. SIPC, Securities Investor Protection Corporation, is different. That's actually to protect against fraud or embezzlement. So that exists to protect your money and your securities that are in a brokerage account. And the idea there is that the brokerage firm or custodian that you work with, they're supposed to keep your money and your securities separate from the firm's own account. But what happens if they don't, right? What happens if the brokerage firm actually commingles your stocks and bonds and uses it for their own account and starts trading with them? Or, it's highly unlikely, but it has happened in history. And the SIPC is there to step in and protect you against fraud. So it does not protect the principal of your assets. In other words, if I go buy 50 shares of General Motors and General Motors goes bankrupt, SIPC does not protect that. But if my brokerage firm takes my 50 shares of General Motors and puts it into their own personal account effectively, then the SIPC will step in. And SIPC coverage today is $500,000 with a $250,000 sublimit for cash.
Right. So I want to be clear that none of that is happening with Tranquilli Financial Advisor or Axos. Okay, let's just cover that right away. But that's a great comparison of the two, because they really are. Just that securities versus cash. FDIC at your bank, SIPC at your investment broker dealer or custodian. So thank you for covering that. As part of the article, you talked about fully insured and fully liquid. And I thought that was really interesting to compare it, if you will, to just going out to buy short-term bonds, which can be considered liquid, of course. And if you're buying U.S. bonds, then you really are looking at the full faith and credit of the U.S. government behind it. So there's not much to worry about there. But there's still call it the function of the purchase of the bonds on your own or through an advisor. Instead, you are trying to accomplish this full liquidity, fully insured through your work. And what does that mean to the client? How do you accomplish that?
Well, this is why people have financial advisors, because there's a really broad range of solutions across fixed income, right? So if you think about the world, equities or stocks, fixed income or bonds effectively. And It really depends on the client, right? Some clients will say, look, I don't need this money for 10 years. This is intergenerational wealth. Lock it up for 10 years. I'm not worried about it, right? I want a long-term bond, and that's fine. Some will say, I want to take more risk, buy me a corporate bond, right? And now you're making a judgment call about the likelihood that a corporation will be able to pay back that bond with interest over time. But on the short end of the curve and the low risk end of the curve, there are a number of different options. The sort of, simplest, most liquid is keeping money in your own bank account, because you know that you can go to the bank and withdraw it same day. You can go to a branch, you can wire funds out.
ATM card, whatever it might be, right?
Right. That's your money. It's as good as cash under the mattress, and arguably it's better because it's locked up in a vault and it's protected. It's insured by the government. So if your house burns down, you don't have to worry about it because your money is sitting at the bank. It's not under your mattress. So that's the sort of, safest, most liquid. Historically, though, that's also been the lowest yielding, right? And most banks pay pretty much nothing on cash today, certainly brick and mortar banks. Part of the reason they pay nothing on cash is they don't have to. It's a market of supply and demand, and depositors don't demand higher yield. So they're happy to take those deposits and pay nothing on them. And you'll generally find that's the case for your checking account, even your savings account. Today, the national savings average is 0.43%, which is much higher than it was 2 years ago, but it's, it's less than 0.5%. So it's not very much. What's interesting is that about a decade or two ago, there emerged the beginning of online banking. And online banking actually started as telephone banking. So it was as simple as, I have my money in my brick and mortar bank, but I can call up a phone number, probably on my old rotary dial phone, and I could call up a phone number and I could enter my account number and I could get a balance, which was really kind of revolutionary at the time, because before telephone banking existed, the only way to check your balance was to go to the physical branch and insert your passbook, and it'll, print out.
I remember it well, Gary. Yeah, just old enough to remember all that.
Yeah. So that was state of the art. And all of a sudden, telephone banking emerged, and now you could call up a 1-800 number and you could get your balance, and maybe you could even transfer money between your accounts. And then the internet came along. In scale. I mean, the internet had been around since the 1960s, but the internet became more accessible in the mid 1990s and early 2000. And so some of these banks converted their telephone banking into internet banking. And that was obviously much better, because now you had a screen. Now you weren't relying on punching in numbers into your phone. You could actually see a lot of information at once. And what they discovered is that the online banks, by not having to have physical branches, were able to take a lot of cost out of the banking system. And as a result, they were able to deliver higher yield to their customers. And so they started competing against the brick and mortar banks by offering higher yield. And for a customer who was sophisticated and said, wait a minute, this has the same FDIC insurance coverage as my existing brick and mortar bank, this was kind of revolutionary. It was said, wait a minute, I can use the internet to get better pricing. And this was sort of around the same time that Amazon was starting to sell books online. And it's really the same business model. It's, wait a minute, I can buy a book, which is a commodity. It doesn't matter whether I buy it in the physical store or buy it online, but I can get a better price point online because of the efficiencies of the internet. And so anyway, fast forward to today, and there are several dozen online banks. They're all FDIC insured, and they're delivering rates that are dramatically higher than the brick and mortar banks. Most of them are paying rates in today's market. In August of 2023, they're paying a little over 4%. On the MaxMyInterest platform, we have banks paying as high as 5.3%. And the reason that they're able to pay even higher yields through our platform is that normally banks, even online banks, spend a lot of money on advertising and customer acquisition. We don't accept advertising dollars from banks. We don't accept fees for click-throughs and that sort of thing, because our view is that would create a conflict of interest. We just wanted to create a marketplace where banks could bid against each other for your deposits and let the highest rate win. And so we basically created a free market for online banks. And as a result, they said, well, wait a minute, you're saving us so much money by not having to pay to acquire customers. We can afford to pass on some of those savings to the customers in the form of higher rates. So how does that all tie into other fixed income alternatives? Well, today you've got a number of options. You could certainly go and buy treasuries, U.S. treasuries. They sell them, 1 year, 3 year, 5 year, 10 year. The challenge with treasuries is that the price of a bond moves inversely to interest rates. So if you buy a bond and then interest rates rise further, the principal value of your bond, if you needed to sell it today, actually goes down. And this is actually what caused a number of bank failures in March of 2023, is that a lot of banks were holding these long-term bonds and then interest rates rose really quickly, faster than they were anticipating, and the underlying value of their bonds fell. Now, the bond won't lose value if you hold it to maturity, but if you need to sell it today, people might not be willing to pay you 100 cents on the dollar on it. And so that's what's called duration risk. And whenever you buy any fixed income security, you have duration risk. Even if I buy a 3-month T-bill, if I buy a 3-month T-bill today and a month from now interest rates go up, people are willing to pay me less for that T-bill if I had to sell it today. So, I think T-bills can be, and even longer bonds can be an effective part of a long-term investment strategy. But if you think about cash as the security or the instrument you're holding because you want liquidity, then it actually makes sense to keep it same day liquid, because you never know when you might want to, buy another stock, or when you might, to make an important purchase, or just life happens.
Whatever it may be. Right. That's right. Help one of the kids out, whatever, or
or you lose your job and all of a sudden, you need to have something to tide you over until you find the next best fit. So, and the funny thing is, because of the preferential rates we've been able to get through the MaxMyInterest platform, we're actually beating the yields on money market funds. And money market funds are not without risk because they're pooled investment vehicles. And under the new SEC rules, there could actually be redemption penalties where you have to sort of kick in additional money just to get your money out. So, the thing that fascinated me so much about cash is it's really the only risk-free investment. And I always pause before saying that, because years of financial training have taught me to say that nothing is risk-free.
Right.
But if you keep
my
your
immediate
deposits,
reaction is nothing is risk-free, Gary.
Nothing is risk-free, right? So what do we mean by risk-free? We mean the same risk level as the U.S. government. Right. And I think a lot of people take the view that, gosh, if the U.S. government were to collapse, well, we all have much bigger issues.
We do. Yeah. We're having a different discussion than a talk about cash on the YouTube video. That's for sure. So I'm going to pause you there, because I think there's so many good things that you just covered. And as I said earlier, this really is a discussion for those that are just getting started and need to understand this, we'll say, moving forward as they go through their career, because the management of cash is part of the financial advice that we'll work on together. But then, of course, those that are already there, that have this conversation, that have the need or the concern for liquidity, and now rates are, we'll say, cooperating a little bit longer term, as you mentioned, what's available on MaxMyInterest. It really fits for all those, I'll say, starting out, because they're learning and they can bring this knowledge through their career with them, or those that are already there who may have done as you started MaxMyInterest off with, be seeking the liquidity, the safety. It leads me to really what is my last question for you. You're familiar with banking. You've been part of the banking business, obviously working with immense sovereign wealth funds. Part of that, you start with the first word, sovereign. They need to be, they need to be there to be used. Talk a little bit, if you would, about what banks are doing with your deposits, if you will, when you're not looking. I'll use that way of putting it. So Gary goes in and deposits $249,900 into Bank A. What did they immediately do with that money that, we'll say, puts it at risk? Now, we're not giving banks a hard time here by any stretch, but I just think it's important to understand what the bank is actually doing, and how a bank like Silicon Valley Bank, as you mentioned, running into the interest rate risk that they did, or actually not the interest, well, it was interest rate risk, but the value risk of those bonds. What are they doing with those deposits when they receive them?
It's a great question, Lou, because, when I was a little kid, I thought that when I deposited my $5 in the bank, which was how I opened my
The
first
paper
bank
route.
account.
That's it.
Yep.
That's
5 years old, my parents said it was time for you to have your own bank account, and I deposited $5. And I just assumed that, my $5 bill was sitting on a shelf there, and that someday I would come back and withdraw that same $5 bill. And of course, that's not how it works. A bank is really a lender, right? A lot of people think of banks as a place where you go to deposit money, but really the core of a bank's business is making loans. And different banks make different types of loans to different types of people and entities. But probably the simplest way to think about a bank is in the context of a home mortgage. And maybe the best explanation of this is the old Frank Capra classic, It's a Wonderful Life, right? Where Jimmy Stewart says, well, your money's not here, it's in Joe's house, right? And that's how it works, you go to the bank and you need to borrow money to buy a home. And the bank really serves as sort of an intermediary. And what they do is they find other people who are willing to deposit money at the bank, and they pool that money and then they lend it out to you so that you can buy your home. And what they have as security against that loan is a mortgage, a lien on the home. So if you fail to make the payments, the bank takes the home and they can then sell the home and take the proceeds to repay all the depositors. So that's sort of a secured loan. Banks also make unsecured loans. And the job of a bank is to originate loans, manage risk, and manage liquidity. Now, what does that mean? Well, originating loans means they have to find people who want to borrow from them, right? So you'll see banks advertising, take out a mortgage from us, a home equity line of credit, a personal loan, a business loan. Banks want to lend money. Now, they only want to lend money to people who they think will repay it to them. And a bank's job is to figure out who they should lend to and on what terms. And if they think you're a riskier borrower, they'll charge you a higher interest rate because some percentage of those riskier borrowers will default on their loan, and they need to have collected enough of incremental interest over the years to make up for those potential losses. And then on the liquidity side of things, they need to make sure that when you go into the branch to withdraw money, that there'll be enough money liquid that they'll be able to
$5
to give it back to you. Right. It may not be your original $5 bill, but it'll be $5. And the whole idea is that money is interchangeable. So that's how a bank works. And where banks get into trouble, they get into trouble one of two ways. Either they make bad lending decisions, they lend to people who aren't creditworthy, or they lend to people who they thought were creditworthy, and then the economic cycle turns and we have a recession, and someone who was a good, honest, hardworking person loses their job and can't make their payments. And the riskiest type of debt for banks is usually credit card debt, right? Because that's it's unsecured, it's a revolving line of credit. So that's one way that banks get into trouble. The other way that banks get into trouble is liquidity, which is everyone heads to the bank on the same day to withdraw their money, and they don't have it because their money is in your house, right? It's been lent out. So under the Federal Reserve requirements, banks have to keep 10% of all checking account deposits liquid in the branch at any given point in time. That's called a reserve requirement. They don't have to keep your savings in the branch, but they have to keep your checking account in the branch, or at least 10% of it. And the idea is that it's highly unlikely that on any given day, everyone is going to come in and withdraw all their money at the same time. But it is possible. And that's what's called a bank run. When everyone goes to withdraw their money on the same day, if everyone did that at a bank, the bank is highly likely to fail. The good news is
there is no bank, Gary. I'm just going to jump in. There is no bank. There are no banks that could handle that. The too big to fail actually doesn't exist, correct?
Pretty much, except for maybe trust banks. So a trust bank does not actually lend out deposits, but because they're not lending out deposits, they're not earning anything, as they can't lend
them out. They're a trust. Either. That's right.
Anyway, the good news in all of this is that depositors, you don't need to worry, because as long as you've kept your deposits below the FDIC limit, the bank can take all the risk it wants. The risk you're taking as a depositor is only the federal government. And so that's really what makes the banking system work. And that's how, we do study all the banks that we support on our platform. We want to understand their business model and what type of lending they're doing and who their customers are. And there's a large bank that failed in March that we decided not to include on the Max platform because we we're concerned about their business model. And, so that sort of vetting is important. But fundamentally, as long as you keep your deposits below the FDIC insurance limit, you should feel comfortable at any bank.
All right. Well, Gary, that is all excellent information, well presented. Thank you for that. So what we'll do is, as part of sending out this video, is we'll include a link to MaxMyInterest. So those that watch and have an interest can go read some more about it. Of course, they can reach out to me. I've had the pleasure of introducing clients to MaxMyInterest, and something that I really appreciate on behalf of clients is that our relationship is purely platonic. Okay, we just make sure we take care of our clients, and as Tranquilli Financial Advisor, we're doing that by making the introduction, and you're doing all this hard work in the background. Well done, Gary. It really is an interesting conversation. It's how the business started, where we are right now. So I'll do this. I'll ask you if you'll come back again sometime, and we'll dig a little deeper into some of the other elements of managing cash, if that works for you.
Sure, be happy to, Lou.
Glad to do it. Thank you again. Gary Zimmerman, MaxMyInterest.com. Again, we'll put a link to their website in the show. And of course, I look forward to talking with all of you soon. I'll include my calendar link. If you'd like to have an additional discussion about this topic, please just book a 20-minute call and be glad to talk with you soon. Hello, everyone. Thank you for taking a few moments to listen to our compliance portion of the MaxMyInterest discussion. This webinar was created August of 2023 and is provided by Tranquilli Financial Advisor, LLC for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or the offer to sell any product. Tranquilli Financial Advisor and MaxMyInterest.com reserve the right to modify their current investment strategies and cash holding techniques based on the changing market dynamics or client needs. There is no guarantee that their assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account the specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Thank you again for listening.